Hey everyone, welcome back to Corporate Decoder, the place where we unravel the financial mysteries behind public companies. And trust me, this latest filing from Customers Bancorp Inc. is quite a puzzle. Alright, fasten your seatbelts because we are diving deep into Customers Bancorp Inc.'s latest quarterly report for the period ending the 30th of September 25. This is a massive document packed with numbers that tell a story. The big question is that story a good one or a cautionary tale? Let's find out. First off, let's get a grip on the big picture here. Customers Bancorp is a bank holding company and its main operation is through Customers Bank. So essentially we're looking at a bank's performance here. They operate across several states with a focus on commercial banking products like loans and deposits, but they also serve specialized businesses nationwide, including through fintech partner. So this is a pretty diverse operation. Now let's talk numbers. The balance sheet for the 30th of September 2025 shows total assets at a hefty $24.3 billion. That is a pretty significant jump from $22.3 billion at the end of 2024. What is driving this growth? Well, loans and leases receivable are up by over $1.5 billion, a healthy 11.8% increase. That is usually a good sign for a bank, meaning they are actively lending money and their cash position is also stronger, up by almost $400 million. But notice the investment securities held to maturity. They've actually decreased by about $190 million, an almost 20% drop. This could mean they are selling off some of those longer term investments, perhaps to fund that loan growth or maybe to manage risk. On the other side, liabilities are also up to $22.1 billion. The biggest chunk of that is deposits, which have grown by $1.6 billion, an 8.3% increase. That is a substantial inflow of customer money, mostly coming from savings accounts and non-interest-bearing demand deposits. This is great for a bank as it provides a stable and often cheaper source of funding compared to other borrowing methods. Now let's look at the income statement for the 3 months ending the 30th of September 2025. Net interest income, a key indicator for banks, is up significantly by over $43 million or about 27%. This is largely thanks to lower interest expenses on deposits and more interest income from those growing loan balances. The bank's cost of funds has decreased, which is fantastic for profitability. However, the provision for credit losses has also climbed by about $9.5 million. This means the bank is setting aside more money to cover potential loan defaults. This increase is tied to that higher loan balance we saw earlier, but it is also a signal that management might be anticipating a tougher economic climate. Ahead net charge-offs are down though, so that is a bit of good news there. Non-interest income saw a massive jump of over $21 million or a staggering 250%. This is largely due to a significant reduction in losses from selling loans. And leases, in the prior year they had a big loss related to commercial clean vehicle. Leases, which is absent this year. Also loan fees and other income streams are up. But here is where it gets a bit concerning for the 9 months ending the 30th of September 2025. There is an impairment loss of over $51 million on debt securities. This is a big hit, and it is explained as the bank deciding to sell these securities to improve liquidity, reduce asset sensitivity, and benefit mark. And this sounds like a strategic move, but writing off that much on investments usually means they took a significant hit. Non-interest expenses are up slightly by about $1.2 million on a quarterly basis, mainly due to professional services and salaries, but technology and communication costs are down substantially for the quarter, likely due to fewer software fees, and servicing costs for the 9 months expenses are up a bit more, driven by professional services. And salaries, though, technology costs keep falling. Despite the mixed bag of income sources, income before taxes is up dramatically by about $54 million for the quarter. This is a testament to that strong net interest income growth. After taxes and preferred stock dividends, net income available to common shareholders saw a very healthy increase of about $31 million or over 70% for the quarter. This is a positive trend, however. For the 9-month period, net income available to common shareholders is actually down slightly compared to last year, losing about $4 million. This dip is largely due to that impairment loss on debt securities we talked about earlier. Now, what about the big picture risks and opportunities? This report highlights that the bank has a diverse loan portfolio spread across different industries and geographies. This diversification is generally a good thing, helping to mitigate risk. But they also mention macroeconomic uncertainties like inflation, changing interest rates, and the ongoing military conflicts in Russia, Ukraine, and the Middle East. These global events can really impact economic conditions and banking operations. The bank is also keeping a close eye on the US banking system, particularly regional banks and their exposure, especially to commercial real estate. That huge jump in non-interest income for the quarter is definitely a bright spot. A 250% increase is massive, driven by the absence of those heavy losses from the prior year. However, the 9-month figure is down mainly because of that significant impairment loss on debt securities. They are selling these assets to improve liquidity, reduce interest rate risk, and boost margins, which sounds strategic, but taking such a large write Down isn't ideal. The increasing provision for credit losses is something to keep an eye on, while net charge-offs are down. The higher provision suggests management is being more cautious about potential future defaults, given the economic outlook. When we look at market risk, Customers Bancorp is showing they are actively managing their exposure to interest rate changes. Their new forecasting model shows that in a rising rate environment, their net interest income could increase quite a bit, but in a falling rate environment, it could decrease. This is typical for banks, but the magnitude of the potential downside is worth noting. Their EVE, or economic value of equity, also shows a similar sensitivity to interest rate changes. Let's talk stock customers. Bancorp has seen a significant increase in its common equity tier 1 capital ratio, well above minimal requirements. This is a sign of a strong financial foundation. A notable event this period was the redemption of all Series E preferred stock, which incurred a loss of $1.9 million. This is a strategic move to simplify their capital structure and reduce future dividend payments. So what is the verdict? Customers Bancorp is showing strong top line growth with net interest income up significantly. This is great news. However, the large impairment loss on debt securities for the 9-month period is a red flag hinting at potential past missteps or a tough market. They're also increasing their provisions for credit losses, suggesting a cautious outlook on the economy, but their strong capital position and deposit growth are positives. They are actively managing their risks and adapting to market conditions. So does Customers Bancorp look like a good investment right now. Their core banking business is performing well, and they are making strategic moves to manage their balance sheet and capital. However, the impairment loss and the cautious outlook on credit losses are reasons to be watchful. The bank is navigating a complex economic land. And while they have a solid foundation, future performance will depend on their ability to manage these external pressures effectively. What are your thoughts on Customers Bancorp's financial health? Based on this filing, let us know in the comments section below. If you found this deep dive valuable, give this video a thumbs up and subscribe for more corporate breakdowns, and hey, join our growing community on Discord. The link is in the description. Thanks for watching, everyone, and we'll see you in the next episode of Corporate Decoder.